Hello everyone, Courtney Nine here, Wealth Manager at Good Life Financial Advisors. Happy spring and welcome to the second quarter. It was really great to see so many of you throughout a very busy first quarter. We spent a lot of time preparing and working through some tax items with many of you. We also saw a lot of you for your regular annual scheduled reviews. And during those meetings or phone calls, depending how we did it, besides any relevant information around the tax season, we of course discussed the market outlook. I've tried to be as realistic as possible with many of you, especially since the beginning of last year, that the road to a recovery from the economic downturn that we've been experiencing would be a marathon and not a sprint. However, with that being said, we surprisingly had a relatively strong first quarter, and seeing those positive returns on statements definitely felt really good, especially after last year. Now we are in the height of the earnings season, so that means companies are reporting their earnings from the first quarter of 2023. And as I always say, earnings and expectations are what drive the markets. We do believe that many of the anticipated earnings results are most likely priced into the market, and the market already has low expectations given the economic environment that we're in. But nonetheless, there may be some surprises on the upside and or on the downside, which will definitely continue to create some of that volatility. Earnings expectations were lowered for the first quarter quite a bit. Estimates were cut nearly by 6%, which is about double the long-term average. And companies put forth some cost-cutting measures such as layoffs, and a lot of you probably heard about that in the news. Some of these companies, especially technology companies, really overhired during the COVID pandemic, and they're cutting their workforce sort of back to those pre-pandemic levels. And many of these companies might be rewarded during earnings season for some of these cost-cutting measures, but I think we're really going to see how this all pans out over the course of the next couple of weeks. Overall, our feeling is that we're probably going to continue to muddle through the market that we're in, and maintaining patience is going to be key to get through this recovery. Inflation pressures are continuing to come down, or starting to come down, and that will help companies, drive some profitability maybe to the positive. But we do also expect that the Fed stop their rate hike campaign sometime in May, and higher interest rates will still sort of exist, and that will affect valuations for companies. With that being said as well, we do anticipate over the next 9 months we should have some continued positive earnings, and we don't see us reaching all-time new highs in the 2023 year, but we also feel like we're going to be in a sideways sort of range-bound zone, meaning we don't see us getting too much higher and we don't see us going too much lower. We're just going to be in this sideways scenario for the foreseeable future. So that's our update for now. If you have any questions, don't hesitate to reach out. I'm here to answer any concerns that you do have, and I wish all of you a very happy spring season. Thanks for listening, and we'll talk to you soon.